right? And you're so excited that you want to get involved. So what do? You get involved, right? But you don't realize that before they even go into mainstream, there's going to be a trap. And that's there to trap you who just got involved. You understand? That's there to trap you who just got involved. Now, what I want you guys to start doing when you analyze your charts is take data, right? And go back test this as much as possible and just see how many wins you actually get besides your losses. You understand? So what you want to do is now take the data, right, from, I would say, 10 a.m. in the morning. So we're looking at about London Open, right? Take 10 a.m. to about 3 p.m., right? And what we want to see is an inducement. We want to see a trap take place, right? Because this is going to allow us to now see the direction of the market, right? So if they take out the low of 3 o'clock, right? That would be the trap to go higher. Or if they decide, right? If they decide, right, to take out the high, now this is just a reverse pattern, right? If they decide to then take out the high, right, of the 3 o'clock high that maybe is just created, right? Then that is a reversal to the downside because they're coming into premium to go into discount. All right. So we want to look at that data and we want to see what happens there because there needs to be a trap, right? They need to trap sellers in order to buy a market. There needs to be a trap. There's always going to be a trap, right? They're always going to induce you and entrap you before they actually move in the direction they wanted to move in. Making sense? So guys, remember this. You never want to get involved in a market unless there is a trap. You always want to wait for that trap to happen. Listen carefully. Listen to that again. You always want to wait for that trap to happen. Right? You always want to wait for that trap to happen. If we know that there's big movement coming in at Hoppers 3, right? It's either the trap is going to occur and then perhaps 4 o'clock, the actual movement of the market makers is about to take place. But we want to see that trap happen before any kind of entry gets taken, before we even think of getting involved. We want to see that trap. They need to trap sellers before buying a market. They don't just buy a market. If 330 comes and price just shoots up, right? The trap was to the upside. It was to trap the buyers. And that just shows you, right, that you want to get involved when that trap takes place to sell the market off. Am I making sense? They're either trapping buyers or sellers, guys. It's as simple as that. If the movement starts to move in momentum to the upside and there is no trap, that is going to be the trap. Yes, word of the day, trap. Right? that is going to be the trap. You want to wait for that. You just don't want to get involved because they're buying the markets, because they're going to buy to sell. So they're going to get you involved into buying the market. That's the inducement. They're getting you involved to buy the market. You get in, price shoots up. Now you're at the top. You're stuck. You're a buyer. You're stuck. Price comes down. What happens to you as a buyer? Exactly. What happens to you as a buyer? They take you out of the market. Right? And then price goes down. Price starts to reverse. So you want to look for a confirmation that's going to allow you to see that this is going to be a trap. It might be a mitigation. It might be an imbalance. Now remember, guys, it's as simple as this. If they take liquidity, right? If they take liquidity, right? If they sweep liquidity, it's the liquidity that will push them up to an imbalance, right? So if we've mitigated an imbalance, we're going for liquidity. It's as simple as that. Don't even question it. Go do your research, go back test it, you'll see. Every time we take liquidity, we take an imbalance or an order block next to an imbalance. But we never take an imbalance and then imbalance again and then no, never. Right? It's an imbalance. Liquidity, drop down to the next piece of imbalance. And then what happens? Maybe come back to an order block and then drop down. You with me? It's never price going one way. It's always liquidity or an imbalance. That's what price runs at. You with me? That's what price runs at. Liquidity, right? Or insufficiency. Liquidity or an imbalance. Liquidity or a fair value gap. So you want to look for those two things in a market. And then we fell. Make sense? All right, so everybody can see that, right? All right, great. So, obviously what we want to do is just quickly go down to a 4-hour time frame. And here we can already see what's most likely to happen and what I mean by a trap. So here we can see, right? And if we're going to talk about a trend line trader, then obviously I don't know how to use a trend line, but probably something of this nature, where price would probably, come price to obviously come in. This is how we're going to get them induced, right? So now they are involved. Now they're looking to buy the market, right? We obviously looking at this level as some kind of mitigation level, right? So they're looking to get involved over here, right? What does this show them? This shows them that price wasn't strong enough to get back to this level, right? Price wasn't strong enough to get back to this level, right? So they now get involved. So what do? They get involved, right? But price doesn't tap into that mitigation just yet, right? What does it do? It goes and it traps the sellers. So now we have a trap for the sellers, right? Now, what do we have over here? We had the buyers. And it's just an example, right? Now price comes down and we liquidate those buyers, right? And at the same time, as we come down, we liquidate these buyers. And maybe only then would we see an actual mitigation that will then lead to perhaps 13,400. But see how that confused you as a buyer and a seller? You with me? Because remember now that the fact that they couldn't get to this level showed you how weak the buyers were. You understand? So they failed to get to that level. Why? Because the buying pressure just wasn't strong enough. So they needed to get momentum from taking out these early buyers. So we trapped them. Get more momentum so we can finally mitigate. Right? Then we have sellers sitting at this level. What do? Price then shoots up, takes out everybody here, because everybody here was already taken out via this mitigation, and price continues in its original direction. Right? Where is price coming to? We could then go to a daily time frame and say that price is coming to mitigate some type of imbalance that is now sitting at this level. And then price can now finally turn and start to make its way down. Are you with me? Now, I'm not saying this is going to happen. I'm not saying it's not going to happen. Right? What I am saying is that what they did was they trapped the buyers and the sellers. And they did it over and over again until they finally mitigated. You understand? And now they finally go back in the direction that they originally initiated, which was bearish, because the bias is bearish. Why do we want to go against the trend? The bias is bearish. So if we don't take out this high, which I highly doubt we will, right? And why do I say that? It's because we've got this huge imbalance sitting at this level. There's this gap in the market, if you can see it there, right? So our final destination would be somewhere around here, whether it's an imbalance or an order block or a breaker, but price wants to come down. So now we've got all these guys sitting over here. Remember, these guys haven't been mitigated. These guys haven't been taken out of the market. We have buyers. So obviously now, once that last piece of the puzzle is taken and we have mitigated that level, there's no need for us to go any higher unless we now want to go create a new high. But if not, then obviously we now want to make our way down. Shit. And perhaps from here, if Nasdaq still wants to continue bullish, then we could now give a change of character. Meaning that now we can start seeing price starting to deliver itself bullish. You understand? Because now if you look at this, the last place that they now want to go to is to fill out and clear out this imbalance. You understand? Because what they've done is they've started to clear it out. Right? Because the imbalance was from day to day. They then came in to about 50% of that imbalance, cleared it out, and then we were left with that, which they've now tapped into once again. So now we are sitting with that as an imbalance, right? So this might be the final touch before price finally now comes down. But there's going to be a trap. You understand? There's going to be a trap that's going to take place before that 4 even takes place. Before that 4 even takes place, there's going to be a trap. Right? Now, if we go to this level over here, right, then it would be this order block that gave us this break. Now, if you look, we haven't mitigated that order block unless we come in and mitigate it. Now, the imbalance sits within that order block. So that order block that created the change of character, right, needs to be mitigated in order for price to start pushing lower. All right. So we now waiting to see what happens between now, today, or whatever the case is, right? Now, also what you want to take into consideration is how many pips usually does Nasdaq and you want to see if that, because that's roughly how far Nasdaq is to pushing into the next confluence. So would that movement allow them to tap into this level? Always look at how far they are from completing their move. And if we look closely, that could work. Since Nasdaq moves, right? So this is obviously a daily time frame, right? So you want to see, right, between their swings, right? You want to see how many pips Nasdaq moves before getting to that point of interest. So NFP could just be a trap today. Do you understand? NFP could just be a trap today. They could literally just trap and not really get into any type of order block or anything of that nature, right? They could very well just give a trap. And a trap would be perhaps Nasdaq could go up and then we trap. Right? The buyers got trapped. So we now have a trap to both sides, as well as grabbing liquidity, sitting at these highs. So it doesn't mean today that, oh my gosh, today it's going to be the end. They're going to tap into that major order block. No, it could just be a trap. You understand? It could just very well be a trap today. Price goes up and then price goes down. What do? We trap the sellers. And then price goes in the original direction that we were all hoping for it to go. But by that time, we're already out of the market. But as we trap to the downside, we trap to the upside. So here there was an inducement take. There was an inducement take. Here there was liquidity. So what did we do? We trapped, went for a inducement to the upside, took the liquidity, and from here price can then fall because it has no reason to go any higher. Are you with me? But NFPs aren't that potent. Yes, they have momentum to them, but not like a CPI movement. You understand? So today, NFP might be the trap, and CPI next week might be the buy. So NFP will trap, right? And CPI will then buy. So remember that we cannot take a trade unless there is a trap. All right. So here, I'm now going to go to the 1 hour time frame. Just to give you a little something. So you can see what they've been doing, right? What happened? We had a trap and a trap. So we're waiting for a trap. You with me? Now, is there some kind of influence that could bring price lower? Two breaks. Right? So even if we look over here, same thing took place. What did we do? We trapped the sellers. Price came down, trapped the sellers, and continued with its move. You wanna wait for the trap. There's always going to be a trap. So before price decided to break multiple structures, which verifies this as an order block, right? And actually as an institutional candle, right? Price shot up, took two structures out. Right? Two structures out. Three structures out. Four structures out. Let's look at that again. 1, 2, 3, 4. That move did so much damage in this market, which now leads me to believe that they could very much go down as a trap in order to go up. That is it's a 1 hour order block, but it broke multiple structures. That makes me understand that that is an institutional candle. Price is going to move drastically away from that. And in most cases, we'll see it break multiple structures, since there's only two structures to be broken, or rather 1, 2, 3, before pulling liquidity. I believe that this move could then be CPI. Reason for that is because we would probably have a situation where there will be multiple traps. So there could be price coming down and then price coming in, but showing that it is weak at this level, meaning there's really no more orders sitting at this level, as price cannot take out that low, and price starts to move its way up. Everybody with me? So we want to look for a trap. The only trap that I can see currently right now, and one that is also validated, would be here. Why? Because there was an inducement. Price went up, came down. We didn't trap. Right? We didn't trap. Price goes up, comes down. Guess what's happening? Let's say price decides to go up and take that liquidity sitting over here. Everybody is going to start to buy this market. And then finally, price comes down. Right? That's the trap. That's what we're waiting for. Right? We're waiting for this low to get trapped in order for price to then continue buying. My question is, why are you going against your bias? You understand? Your overall bias is bearish. Yes, we might have a minor bias, a minor bias that is showing price moving higher. That's what they want you to believe, of course. Right? Because everybody over here is still sitting at this level. Everybody over here is still sitting at this level. Everybody here and here and here are all still sitting at those levels. You with me? So this is a game of cat and mouse. This is a game of patience. They have all the time in the world to do what they want to do. They'll take each news event as they feel necessary. You understand? So you want to just make sure that there's a trap, because if there's no trap, then the movement is not taking place. If there's no trap, then the movement is not taking place. All right. If there is no trap, then the movement is not taking place. Let's go to a lower time frame. Let's go to a 15-minute time frame. Same thing happens. they trap, and then they buy. So here we trap, and then we buy. Right? Then price goes down, price goes up, we trap, right? And then we buy. There's a trap before an expansion. There's always a trap. They need to get momentum from somewhere. Yes, the trap is basically a stop hunt. So you trap the sellers, and then the buyers start to get involved. Then you trap the buyers. Then the sellers get involved. See? Cat and mouse. They're putting you guys against each other as buyers and sellers. So, again, there's always a trap before a movement. Let's look over here. Before this expansion took place, they trapped sellers. You with me? They trapped sellers before moving higher. Now, let me give you some gems here quickly. So, what you want to do, or try to do at least, is go to your 1 hour time frame. Allocate everything from 10 p.m. till 3 p.m. So what you want to do is allocate. So here we are at 12:06. So roughly let me just draw this out quickly. Right? What we want to do is we want to, let's rather go to the 30 minutes. Okay, let's go to the 30 minutes time frame. That way it's going to show my separators. Oh, okay, I don't know why it's not showing it. Let me just quickly go to my indicators. So here's my indicators. And let's put in the weekly. All right. So here's Thursday. And then we have Wednesday, Thursday. So here we have Thursday. Here we have the high, which is 10 o'clock's high. Right? And then at 3 o'clock, we had the trap before the expansion. All right. Simple as that, guys. I'm teaching you something here. And go back test it. You'll see it for yourself, right? Just before the movement takes place. 3 o'clock. They're going to trap the sellers. Right? Because remember, this move doesn't take place. Right? This move doesn't take place until this happens. You understand? So here we have the high, and here we have the closing at 3. There it is there. New York opened bullish, trapped. Buyers moved down, trapped. Sellers, and then went into its original direction. And after that, continued going higher. And this works over and over and over again. So here we are, we're looking for 10 o'clock. So we're looking for the opening bell, right? So roughly that being the high. So either, how we're going to know NFP is either we are going to trap to the upside and then trap to the downside before going higher, or if price continues during the day to just kind of like consolidate, right? And then let's say roughly price starts to do that, and then price comes down. And here, New York opens. So this would be our closing. Right? Then we're much further to the downside than we are to the upside. So I believe that they would rather trap these guys and all of these guys to the downside. So now what we're doing is we're trapping these sellers And then we could then go and perhaps grab that liquidity to the upside. You with me? So what you want to do is we've already allocated the high. It's gone to 10. We've allocated the high. You understand? We've already allocated the high. What we want to do now is once New York closes, right? Once New York opens, rather should I say, once New York opens, right? We've got about 30 minutes before something takes place. Do you understand? So I think New York opens at about 2:30. We start seeing movement roughly at about 3:30. Right? So what we want to look for is just that trap. Right? They're gonna create that low, right? That we are going to close off with when New York opens. There's going to be a low they're going to create for the end of the London session. New York is then going to start to play out. You with me? And obviously, NFP news comes out, if I'm not mistaken, at 2. So we won't see massive movement, right? But we will see direction. You might find out that at 2:02, 2:02, there's that trap. Right? So we're looking for that trap. So once we identify that trap, right after we've closed off the low of the London closing, right? They want to liquidate everybody that's trying to get involved. And that's when you want to get involved. Now, there might be multiple traps. You could find out that they'll trap, and then trap, but don't lose confidence now. They could trap again, and then finally start to go higher. You with me? So that's just an inducement because now everybody's starting to sell the market off. What did they do? They created a low. We had a break, a retest. So obviously we're looking for price to go lower. Price goes lower, takes out the sellers. Price taps into a certain level. And price then starts to go higher. But one thing I'm going to tell you, if you don't want to get smacked out of this market, let them first trap the sellers. You with me? Now, go back test it. Now I expect you guys to go back test it and see how many times this plays out. Over and over and over again. Because they use from 10, right? From 10 till about 2, they use that fuel to gather orders. To then focus the main move. Using that fuel that they've gotten from the previous session. What about my head? What's wrong with my head? Nothing wrong with my head. What's wrong with my head? Yes, wait for it to reject, if you want to call it that. Wait for a stop hunt, if you want to call it that. But wait for the movement to end. Find a point of interest, stick with that point of interest, and be patient and wait for that trap to happen, because the trap will probably be that mitigation of your point of interest, and price will then start to go higher. It works on everything, US 30, everything. Before a major move takes place, they want to trap the sellers or they want to trap the buyers. Now, depending where they are going to be at 2:30 p.m. is most likely where they're going to trap first. So they might trap to the upside, grab that liquidity, and then trap to the downside. Or if they're making the way to the downside, right? If they're making their way down to the downside, right, into a discount, then they're probably going to trap to the downside and then make their way back up to premium. Anyway, I'm done. I hope you guys have all learned something. I've now given you a blueprint to understanding how an endorsement works versus liquidity. So they're going to get you involved and then get you out of the market. But they need to get you involved before they can get you out of the market. You understand? So they need to set the trap. How do they set the trap? They get you involved. Right? They get you involved. Then, what do? They take you out. So they get you involved, right? So that you don't become a buyer. They take you out as a seller. You understand? They take you out as a seller so you don't become a buyer. So don't fall for that trap. Because it's going to leave you behind. Because, you see, you've already kind of like understood the direction they're going in. They're obviously going higher. Right? Because we have a major point of interest sitting at the top over there of that previous high. There's a beautiful imbalance or an order block, whatever you want to call it. And that's their point of interest. But they need to trap whoever they need to trap in order to have nobody go with them. They want to be in it alone. So what do? Wait for them to trap whoever they need to trap. Don't get involved. Wait for that trap to take place. Then we're going to see that expansion. All right. Anyway, hope you guys have all learned. Thank you for the compliment on my head. If any even came through, whatever the case is. But yeah, go out, go back test. And I will see you on the other side.